If your family's entire financial life can be trapped by one locked door, you do not have a savings plan. You have a hostage situation. Most people never hear that sentence because the financial world survives on a softer story. Put your money in the bank. Be responsible, stay liquid, trust the institution, watch the little number on the screen, sleep well. But I have spent my life learning that what feels safe and what is structurally safe are often two completely different things. That difference does not matter on an ordinary Tuesday. It matters on the Tuesday when the door does not open. In 1929 and the years immediately after it, thousands of American banks did not stumble, merge, or quietly reorganize. They failed people who had worked, saved, delayed pleasure, and done everything the respectable way, walked to the same branches they had used for years, and found steel, glass, paper notices, and silence. Their discipline was real, their prudence was real, their loss was real too. And yet not everyone was destroyed. That is the part I want you to hold in your mind because that is where the real lesson begins. The winners were not magicians. They were not clairvoyant. They were not sitting in private clubs with secret phone lines to Washington. They simply were not standing behind the same door as everyone else. They were using a different structure. That is what most people miss about financial history. They study events. I study architecture. The crowd studies headlines. I study plumbing. When you do that long enough, a pattern becomes impossible to ignore. Money is not protected by labels. It is protected by structure. Brand names do not save you. Marble lobbies do not save you. Familiar apps do not save you. A promise is only as strong as the chain of institutions that stand between you and the asset you think you own. Most families keep their life savings in one system because one system feels simple. But simplicity can be expensive when it is built on concentration. The day everything works. Concentration feels efficient. The day confidence breaks. Concentration becomes a trap. I call that trap. Single door risk. Single door risk is what happens when your paycheck, your emergency fund, your bill pay system, your card access, your reserves, and your sense of safety all sit behind the same lock. You may have several accounts, you may have different balances, you may even think you are diversified because you have checking and savings and a money market feature. But if those balances all depend on the same institutional chain, the same payment rails, the same insurance logic, the same crisis response, then you do not have multiple protections. You have one door wearing several costumes. That is the first thing I want to break in your mind. The second is even more uncomfortable. Most people believe their problem is choosing the right bank. It usually is not. Their problem is misunderstanding what a bank deposit actually is. A bank deposit feels like stored property. Legally and structurally, it is a claim. That sounds like a small distinction until you meet a crisis. Then it becomes the whole story. If the institution remains healthy, your claim behaves like cash. If the institution becomes impaired, your claim behaves like a line item in somebody else's damage. That is why I say the first real mechanism is structure blindness. Structure blindness is the habit of judging a financial home by how trustworthy it feels rather than by what it is built to do under stress. People ask whether the bank is old, famous, modern, friendly, convenient, local, national, digital, or prestigious. Those are branding questions. The question that matters is much sharper. Who owns the institution? What risks does it take with deposits? Who insures it? What happens if the surrounding system seizes up all at once? And how many intermediaries stand between me and the final guarantee? Those questions sound dry until history turns them into a personal emergency. During the banking disasters of the early 1930s, all institutions did not break equally. Some were designed around depositors, some were designed around shareholders, some stretched for profit, some stayed narrow and conservative. What most people remember from that era is panic. What I remember is stress-sorted institutions by design. That is still true. The same sorting happens in every era. It happened in the savings and loan crisis. It happened in 2008. It happened in regional banking stress more recently. When pressure rises, slogans disappear and structure takes over. In calm markets, bad architecture can borrow confidence from the weather. In a storm, only the frame matters. That realization leads to the third mechanism, and this is where modern savers get lulled to sleep. I call it insurance comfort. Insurance comfort is not the same thing as true redundancy. Insurance can be useful. Insurance can be necessary. Insurance can prevent panic in ordinary conditions. But most people stop their thinking at the existence of insurance rather than continuing on to the limits of insurance, the scope of insurance, the speed of access, the discretion of intervention. And the difference between a small contained failure and a system-wide fracture, that difference is everything. If a single institution fails in an otherwise calm system, the machinery usually works. Regulators step in, claims get handled, people calm down, the story ends with only mild inconvenience for most insured depositors. But a structure built to calm scattered fires is not the same as a structure built to survive a city burning from 4 directions at once. That is why serious people do not treat an insurance label as a complete strategy. They treat it as one layer in a broader design. You should do the same. And right now, there is another mistake I want you to avoid. Most people think caution means drama. They imagine that if you take banking fragility seriously, you must be predicting the apocalypse, burying gold in the yard, or screaming about the end of civilization. That is not my approach. I do not operate from melodrama. I operate from asymmetry. If a low cost adjustment can meaningfully reduce ruin, I make the adjustment. That is all this is. You do not buy fire insurance because you expect the house to burn tonight. You buy it because the downside is too large to meet unprepared. You do not fasten a seatbelt because you predict a crash on every trip. You fasten it because the math of protection beats the vanity of pretending nothing bad will happen. Cash architecture should be treated with the same sobriety. Now let me give you the deeper truth the personal finance world rarely teaches cleanly. The real opposite of fragility is not confidence, it is optionality. Optionality means that one failure does not trap the whole household. One frozen rail does not stop all movement. One decision by one institution, one agency, one weekend crisis committee, one payment outage, one panicked line of depositors does not determine whether your family can buy food, meet payroll, pay the mortgage, or keep its dignity. Optionality is what the survivors of bad systems always buy first. And that brings me to the old lesson hidden inside 1929. The people who came through that era best did not merely have cash. They had layers. They understood that money has jobs, and each job deserves its own location. Transaction money is not the same as reserve money. Emergency bridge money is not the same as protected sovereign liquidity. When you dump every job into one account because the app is easy, you are not simplifying wealth. You are asking one door to do 4 different jobs. That is foolish engineering. So let me translate the old survival logic into a form you can actually use. Now the first layer is what I call utility cash. Utility cash is not where you prove you are safe. It is where you remain functional. This is your bill pay layer, your direct deposits, your debit card usage, the money that needs to move through ordinary life rent. Groceries, subscriptions, auto pay, payroll, if you run a small business, all the everyday friction of modern living. This money belongs in a federally insured account at a large institution because convenience matters for this specific job. But here is the discipline. This is not where your entire financial identity belongs. Utility cash should be enough for the work of the month, not the fear of the decade. If your household burns through $6,000 a month, maybe you keep 1 month or a bit more there. If you run a business, maybe you keep the operating float you truly need. But once you start treating your primary commercial bank like the permanent resting place for every reserve you own, utility cash mutates back into single-door risk. This is where math helps. Many people keep 6 months, 12 months, or even several years of cash at the same bank because they confuse accessibility with wisdom. Yet the extra yield is usually trivial, and the concentration cost is enormous. The first month of money solves movement. The 7th month of money sitting in the same channel solves almost nothing extra while enlarging the amount vulnerable to the same institutional event. That is not strategy. That is inertia dressed as safety. The second layer is what I call the mutual shield. The mutual shield is reserve cash held at a credit union or comparable depositor, first institution operating under a separate insurance framework from the commercial bank. Why do I like this? Because separation matters, ownership structure matters, incentives matter, redundancy matters. If the first layer is your daily engine, the second layer is your alternate runway. This is where financial design starts becoming intelligent. A member-owned institution does not look at depositors the way a shareholder-governed institution does. That does not make it invincible. Nothing human is invincible. But it does create a different cultural and legal orientation toward risk. In finance, orientation shows up when conditions worsen. The institution built first for members behaves differently from the institution built first for return on equity. Most savers never think this way. They say, money is money. A bank is a bank. That sentence has cost people fortunes. No, structure is not structure. Insurance is not insurance. Incentives are not incentives. If you can place part of your reserves in a separate system with a separate guarantee logic, you have already improved the household balance sheet in a way most people never consider until after the lesson becomes expensive. Think of the first two layers this way. The first is for smoothness. The second is for separation. Smoothness keeps life moving. Separation keeps one failure from becoming total captivity. Now we come to the third layer, and this is where people get emotional and sloppy. I call it the transaction bridge. The transaction bridge is physical cash held outside the banking system in modest, usable denominations for a very specific purpose, not as your ideology, not as your life savings, not as some theatrical rejection of the modern world. It exists because real crises often begin as access problems before they become solvency problems. That distinction matters. A family can be financially sound and still become temporarily paralyzed if digital payments freeze, cards stop clearing, wires stall, branches limit withdrawals, or systems go dark for 3 days in the middle confusion. In that moment, a few hundred or a few $1,000s in the wrong form can be close to useless, while a smaller amount in the right form can preserve calm, movement, and dignity. History teaches something here that sounds embarrassingly simple until you need it. Big bills look like security. Small bills behave like utility in periods of stress. Change becomes scarce. Merchants get cautious. Systems get selective. And people stop thinking generously. The bridge is there to keep your household transacting through that narrow window between digital confidence and restored normalcy. For many families, 1 to 4 weeks of ordinary expenses in mixed small denominations is enough. Not because that outruns every crisis. It does not. It simply buys time. And time is often the missing asset during the first stage of disorder. This layer has obvious weaknesses. It earns nothing. Inflation nibbles at it. Physical security matters. But insurance always has a carrying cost. The mistake is not that this layer costs something. The mistake is demanding yield from a tool whose real job is continuity. A hammer is a terrible pillow. A bridge is a terrible permanent house. Use each tool for the job it was built to do. Now we arrive at the fourth layer, and this is where the architecture becomes powerful enough to change your peace of mind. I call it the direct claim. The direct claim is short-term United States Treasury exposure purchased directly through the government's own system, rather than left as an indirect banking promise. This is the modern descendant of the old idea that mattered so much in bad times. If you can remove the intermediary between your cash and the sovereign guarantee, you have removed the point of failure that ruins ordinary depositors. Read that again, because this is the center of the whole blueprint. If there is no intermediary between you and the guarantee, the intermediary cannot trap you. That is why this layer deserves serious attention. A short Treasury bill is not your claim on a private institution that might need an insurance fund, an emergency merger, a weekend rescue, or a political exception. It is a direct obligation of the United States government. Either the sovereign honors it or it does not. There is no separate bank in the middle that can fail and force you into line, while officials improvise solutions. And when you buy these short-dated bills directly, the design gets cleaner still. You reduce counterparty clutter, you shorten duration, you preserve yield, you keep maturity frequent. You turn cash storage from blind trust into engineered exposure. That is intelligent conservatism. The financial world loves to market complexity because complexity sounds sophisticated. But a lot of true safety is not complicated. It is simply unpopular because it requires thinking about plumbing instead of stories. Many people would rather believe a famous logo protects them than spend 15 minutes learning a better structure. Comfort is easier than architecture. It is also more expensive. Now let me explain why the direct claim changes the emotional equation so much. When people hold all their money inside the same commercial banking channel, they are not just exposed financially. They are exposed psychologically. Every rumor, every headline, every social media panic, every whispered concern about reserves, real estate losses, unrealized securities losses, or regulatory confusion lands directly on their nervous system because everything they own is standing in the same building. That is exhausting. But when a meaningful share of your reserve sits in short sovereign obligations outside the ordinary deposit channel, you start to feel something most people have never experienced around cash. I call it refusal power. Refusal power is the ability to say no to panic because you are not cornered by one system. It is the ability to let bad information arrive without immediately becoming prey to it. It is the ability to watch noise without joining the stampede because your household architecture already assumed that confidence can break. This is one of the deepest forms of financial freedom, and it is almost never sold. Honestly, most people think freedom means higher returns, bigger upside, more aggressive growth. Sometimes freedom is simpler than that. Sometimes freedom means knowing that a single frozen app cannot hold your family hostage. That is the identity flip I want for you. I do not want you thinking like a depositor. I want you thinking like the chief liquidity officer of your household. A depositor asks, which bank should I trust? A chief liquidity officer asks, which job does each dollar perform, and what structure best protects that job under stress? That one change in identity will improve your financial life more than most hot investment tips ever will. Because once you adopt that identity, you stop chasing reassurance and start designing resilience. You stop asking for a perfect institution. You start building an imperfect but redundant system. You stop treating convenience as safety. You start treating convenience as one feature among several. You stop confusing a number on a screen with sovereign access, transaction continuity, and structural separation. You begin to see that those are different assets pretending to be one. Now, whenever I speak this directly, someone says, "This sounds too cautious. Why bother if most of the time the system works?" My answer is simple, because the price of preparation is visible, but the price of concentration is usually invisible until the bill arrives all at once. Preparation asks you to set up another account, learn one government portal, hold some physical notes, think in layers, and accept that a little bit of money should optimize for resilience rather than excitement. Concentration asks nothing from you today. That is why people choose it. It feels free. It is not free. It simply sends the invoice later, and it sends it during the hour when you are least able to pay. There is another advantage to the four-layer approach, and it is one that investors often underestimate. It clarifies time. When all cash sits in one place, every dollar feels the same, and sameness breeds laziness. But when you deliberately separate daily money, reserve money, bridge money, and direct sovereign liquidity, you begin to think more clearly about purpose. Purpose improves behavior. Behavior improves returns. Not because the architecture itself is glamorous, but because it stops random emotional leakage. A person with clear cash layers is less likely to sell good long-term assets. In a panic, less likely to lunge for dumb yield. Because idle cash feels psychologically wasteful, less likely to freeze when disruption hits, less likely to mistake motion for control. This is the quiet commercial value of proper cash design. That protects not only the dollars in the layers themselves, it protects the rest of your portfolio from the bad decisions people make when liquidity suddenly becomes uncertain. Let me go one step further. If you are building a serious life, cash is not merely a buffer. Cash is command. Cash is what lets you wait when others must act. Cash is what lets you buy when others must sell. Cash is what lets you ignore the emotional blackmail of markets, employers, lenders, and institutions because you have room, oxygen, and time. But command only belongs to you if access belongs to you. If access can be interrupted by one door, then command was partly imaginary all along. That is why this subject is bigger than bank safety. It is about sovereignty at the household scale. Now let me make it practical in the plainest way I can. If I were helping an ordinary family build this from scratch, I would not start with ideology. I would start with an operating map first. Calculate the true monthly burn of the household. Not your fantasy number, not your best month, your real number. Housing, food, insurance, utilities, transportation, debt service, child costs, recurring obligations, medical basics, necessary subscriptions, the whole thing. Second, decide how much must remain instantly convenient. For many people, that is roughly 1 month of expenses, sometimes a little more, especially if income timing is irregular. That belongs in the utility cash layer. Third, decide how much reserve you want in a separate insured channel, 3 months, 6 months, whatever fits your life, your industry, your health, your business exposure, your risk tolerance. That belongs in the mutual shield layer, not piled on top of the first by habit. Fourth, build the transaction bridge, small denominations, safe storage, sensible amount, enough to function through a short disruption without needing anyone's permission. Fifth, move the deeper reserve into the direct claim layer through short-term Treasury bills purchased directly with maturities frequent enough that you keep optionality high. 4-week bills are attractive because they restore access often. The point is not to predict the perfect rate path. The point is to own liquidity without sleeping under the same roof as every other depositor. Sixth, review the system once or twice a year. Jobs change, families grow, businesses expand, expenses move, risk changes. A cash architecture is not a shrine. It is a living operating system that is the protocol. Simple enough to implement, serious enough to matter, and strong enough that if a headline ever arrives on a Sunday night saying one institution failed, another is in trouble, a payment network is under strain, or officials are debating emergency measures, you do not have to build your thinking inside the panic. You build it before the panic. That is where the real edge lives. Not in prediction, in commitment. People admire investors for making dramatic calls, but some of the best financial decisions are quiet. They happen before anyone is applauding. They happen when the threat still sounds hypothetical. They happen when neighbors think you are being overly careful. They happen when there is no reward except the absence of future regret. I have lived long enough to tell you that absence of regret is worth a great deal. And I have studied markets long enough to tell you that fragility usually hides inside things the majority treats as normal. Nobody feels stupid while the system is still working. They feel stupid only when they discover under pressure that normal was never the same thing as protected. That discovery is one of the most expensive in finance. So here is the mirror I want to leave you with. If your bank app went dark tonight, if branch access froze tomorrow, if officials spent the weekend announcing emergency guarantees, exceptions, mergers, or temporary controls, would your household still be functional on Monday morning? Could you pay for food? Could you meet your obligations? Could you wait calmly for facts instead of joining the sprint toward the same locked door? If the answer is no, then you do not have a cash problem. You have a design problem, and design problems should be fixed while the lights are still on. That is your choice. You can keep calling one door a plan because it feels familiar, because changing systems is annoying, because the crisis has not happened to you yet, because most people around you are still doing exactly the same thing, or you can do what sensible people in every era eventually do once they understand the structure. You can separate functions, you can buy optionality, you can replace trust with architecture, you can turn cash from a blind deposit into a layered system of movement, continuity, and direct claim. One path keeps your financial life convenient, right up until the moment convenience fails. The other path asks for a little discipline now and gives you a completely different future relationship with fear. I cannot promise you there will never be stress in the banking system again. No honest person can promise that. I cannot promise every institution will always behave prudently. Every regulator will always act instantly. Every guarantee will always feel seamless in real time, or every frightened crowd will remain calm when the first door locks. But I can tell you this, when the door closes, structure decides who waits outside and who keeps moving. That decision does not get made on the day of the panic. It gets made before. Make it while the door is still open.